What's up, everyone? It's Caddy with Money Vesting. I just want to make sure that you guys can hear me. Hopefully, the audio and the video is working. So just give me a thumbs up if everything is working well. I'm gonna pop out the chat here on the side. Put you guys over there. Just give me a thumbs up if everything is working. And we should be all set. And good morning, everyone. We got inflation in under 9 minutes right now. So we got inflation numbers coming out very, very soon, in under 8 minutes. And markets obviously dropping quite a bit. We are seeing QQQ, SPY pretty much selling off a little bit. And then we also have the yields rolling over. So 10-year yields are down with volatility pushing higher right now. It's back up to over 27. So we are seeing the VIX up over 16% at the moment, with crude oil prices dropping down a little bit at the moment. So again, just give me a thumbs up. Audio could be a little bit higher, so just turning that up a little bit more. So just let me know if everything is good. I don't want to be screaming, so hopefully it's a lot better now. So just let me know. Perfect. Great. So yes, PPI numbers coming out in under 7 minutes. We'll be talking about that, of course, as soon as the numbers come out. Pre-market, we are definitely gapping down pretty aggressively, with Tesla down over 1.8%. We've got Google here down 1.4%. And then we've got Apple, of course, down 1%. Microsoft also pulling back, with the 10-year yields. Pretty much all yields across the board are rolling over once again, with gilts also falling. We've also seen European stocks sell off. So Stocks 600 is down over 2.3%. So pretty aggressive move here. And the ECB, I forgot to mention my Twitter post, the European Central Bank meeting is going to be tomorrow, March 16th. And that's also going to be on monetary policy. So monetary policy meeting in Frankfurt. So that's going to be super important. We'll see what Christine Lagarde actually does, whether we raise rates, not raise rates. That's going to be super important for the market. And Credit Suisse shares tank after Saudi Backer rules out further assistance. So Saudi, there was a company, I forgot what the name was, Saudi National Bank. They pretty much funded Credit Suisse, I think last year, at close to $4 or $5 billion. I forgot what, might have been $9 billion. Let's take a look. Just reading it for the first time here. Several Italian banks were all subject to automatic trading stoppages. Credit Suisse largest investor, Saudi National Bank, said it could not provide the Swiss bank with any further financial assistance. According to a Reuters report, we cannot because we would go above 10%. It's a regulatory issue. And let's see what that number was. So Credit Suisse biggest backer, Saudi National Bank, has said it won't provide any further assistance. So the stock was obviously down pre-market. Let's take a quick look. Credit Suisse Group is pulling back a little bit over. By the way, let's just do our quick poll here, and I'll go over the expectations very, very quickly. PPI numbers today. All right, down 25, almost 26% right now, pre-market, trading as low as $1.86. So definitely selling off quite a bit at the moment. And quickly going over the expectations, the year-over-year numbers pegged at 5.4%. So let's just quickly do a poll. Comes in above 5.4, at 5.4%, or below 5.4%. So the poll is out. Make sure that you do vote. And we'll see what those numbers look like in about 5 minutes or so. I'll do an audio check just to make sure everything is working. We'll kind of minimize this screen just to make sure that, we've got that covered with the markets also, and seeing the market's reaction to that. So we got the QQQs here. We've got the SPY. I'm going to switch the SPY over to the bottom right, and the yields obviously down below, dropping 4.6%. The 10-year yield is down, trading as low as 3.5% at the moment. So good PPI numbers can save the day. Even decent numbers will cause a mass sell-off. More banks collapse in the EU. Yep, so we're just going over that. Credit Suisse here dropping 26%. Futures getting hammered pretty hard. Good morning, friends. It's time to share God's love. It will heal the world. Have a blessed day in Jesus' name, friends. So thank you so much for that. Really appreciate it. And perfect. The audio should be good now. And just give me a thumbs up if everything is working well. I just want to make sure that we're not having any issues. I'll do an audio check here in just a minute. By the way, I posted another video earlier today, literally 30 minutes ago, which I think is going to be super, super important. This is not a video that I would miss out on. And the reason I say that is because we pretty much go over a whole spreadsheet, and there's also a gift included. If you watch that video, you will get a gift in that video that I'm also giving out for free, and it's available to the entire public. So that is going to be an additional incentive for you to check that out. That's a video that I posted 30 minutes ago. So again, 3 minutes, and dollar index is in the rocket ship to the moon. So yes, DXY pushing higher on a day like today is very normal considering yields are lower and volatility is higher. And look at the move on the dollar here, pretty substantial push in the last 30-minute candles here has pushed up 1.26%. So pretty substantial move here for the dollar, obviously putting a lot of pressure on equities, and considering both US and Euro equities, but they're both selling off quite a bit. So 41% expectations at about 5.4%. PPI, it's kind of mixed, right? Above 5.4%, 37%. Oh, it just shifted a little bit. 40% now expecting above 5.4%, which is the majority. 30% at 5.4% and 22% below 5.4. So definitely going into this print a little bit more bearish, or leaning a little bit more towards the bearish side for this print. And again, I'll do like an audio check just to make sure that everything is working. So we'll kind of listen in on what the report's going to be like. So about 2 minutes, 1:30. And I've also got BLS open over here. I'm going to flip that over on this side, and we've got the BLS PPI numbers open here. So we're going to open up that PDF as soon as the numbers come out. And again, final demand advances 0.7% in January. Goods rise 1.2%. Services increase 0.4%. So this was the report back in January, 0.7% increase month over month. And right now the market's looking for... and retail sales, by the way, I forgot to mention, retail sales are also coming out. If they are stronger, if you don't see retail sales pulling back, forgot to mention this. This is crazy. Retail sales are also due at 8:30 a.m. Eastern, right? So if you don't get a softer print, then that's going to raise the probability for further rate hikes, absolutely. And we might be in a little bit of a hawkish environment once again from the Federal Reserve. So anyway, I'm going to turn this up a little bit. We've got a couple minutes, a minute actually left. So I'm going to turn that up, and I'm going to shut myself out here. By the way, when the audio starts playing, just give me a thumbs up in the chat, please.
Welcome back to Squawk Box. Rick Santelli here, live at CMEHQ with some important breaking news. A lot of important breaking news. Let's start out with our February reads on the Producer Price Index. Expected to be up 0.3. Buckle up, people. Down 0.1%. Down 0.1%. We all know that in December it was down 0.2, so we are revisiting that. Obviously, that is an important issue when you get back in negative territory. You're actually lowering some of those prices versus changing the rate of change. Strip out the all-important energy, a much lower number. Unchanged, expected up 0.4. Strip out food, energy, and trade, up 0.2, expecting up 0.3. Up 0.2 equals the best numbers that we've had going all the way back to January of 21. And that, of course, was last month. It was up 0.2. Excuse me, that was November. December of last year, December. January, of course, we were up 0.6. Now, year over year, probably the most important. Year over year, we're expecting 5.4. 4.6 on year over year, 4.6. That is the lowest level going back to March of 21. And if we strip out food and energy year over year, it is 4.4. 4.4, and the high water mark there, just so people realize how far we have come, the high water mark there was 9.7. If we strip out food, energy, and trade, it's also up 4.4. So these numbers have really come down rather dramatically. That 4.4 brings us to the lowest level also since March of 21. You can see interest rates going down. We're under some important moving averages, under 3.5% now in a 10-year. If we look at Empire, a blowout negative number at minus 24.6. Now let's go for retail sales. These are February numbers, down 0.4%, exactly as expected. Exactly as expected. That's the worst number since Dees when it was minus 1.1. If you strip out autos, it is down 0.1%. Also the weakest since December, exactly as expected. And if we look at retail sales, ex autos and gas stations, unchanged. We're expecting down 0.2%. So far, that's about the only bright spot. But remember, sequentially, that's following 2.8. And finally, the control group that gets used in other higher up the food chain economic data points, up 0.5%. That isn't too bad considering. Up 0.5% is only as good as our last look, which was up 2.3, and that happened to be the best of all of last year going back to January. Interest rates have moved down, not as much as I would have thought, and that's most likely because flight to quality, flight to safety has taken a big bite out of all the buying that has already occurred, and adding some in is becoming a little bit bigger task. If we look at the pre-opening equities, of course, very meager bounces. And let's not forget, all this concentration on Europe, I would just say two words: negative rates. Anybody who is surprised that when we were close to 19 trillion in negative rates, much of which was in Europe, that ultimately that this would have to happen, I would be shocked if we didn't see volatility in a banking system that was anything but profitable in Europe. Melissa, lead back to you.
Yeah, Credit Suisse, by the way, session low is down 27% right now. Rick, thank you. Steve Leisman joins us. How does this factor into the Fed's mix of factors to weigh?
Well, this PPI report is a very good report if you're fighting inflation. It shows that there is less inflation up the inflation chain here. And there's some things in here that are in line with what folks thought was going to happen in the process of bringing down inflation. The one that stands out to me, a couple of them, the PPI for trade, that's a proxy for margins being down 0.8%. Transportation and warehousing, Melissa, as you know, we've been following some of the declines in shipping out there. That's down 1.1%. And then, of course, there was the energy decline. So overall, I think this is a positive number for the outlook for inflation. PPI can lead. PPI can be can go along with what's happening in CPI. Also, when I look up the chain, processed goods for intermediate demand up 0.4. And then the other thing is, I'm going to take a pass on judging the retail sales number, in part because January was a real outlier. We think we had more spending in January than is normal. February could just be a kind of bounce back or bounce down from that, I guess is the way to put it. So here we are, and I just want to tell you what's happened to the Fed Fund futures here, Melissa, which is now we're 50, well, we were 50-50 for a minute. Now we're still banking on that cut. There's a weird trade out there. I'm going to talk to some Fed funds guys when I get off air here, and I'm going to ask them what's going on. You have this quarter point still is a more than 50% probability for March. But after that, if you look at that January 24 contract, it just goes straight down, and tremendous amounts of cuts are now built in for the back end of this curve here.
Wow. Steve, thank you. Steve Leisman.
Okay. Coming up next, billionaire investor Mike Novogratz. We're going to talk to him about this morning's market sell-off. We'll also talk about Bitcoin's rally on the other side of it. Credit Suisse continuing to fall. We're now looking at a bank stock that is off close to 30% this morning, 28.29%.
So we've got pretty good inflation numbers and we got really good retail sales numbers too. I was actually quite impressed with the retail sales numbers coming in at negative 0.4% month over month. And this was something that we did expect. I mean, we did see like a January revision back higher, pretty substantial. But February, a huge decline, consumer not spending as much. Retail sales are down. X vehicles month over month were down about 0.1%. And X vehicle and gas month over month, we're flat, right? We're not really moving much. And when it comes to PPI, I'm going to reload that, a huge decline. Consensus was 0.3% increase month over month. We got negative, right? So we actually saw deflation on a producer price basis, negative 0.1%, 4.6% year over year versus 5.4% consensus. This is actually a big decline from 6% same time last month. And then X food and energy flat. We've got year over year for core sitting at 4.4 now, down from 5.4. So one full 100 basis points coming down. X food, energy, and trade services 0.2%. So much less than what we expected, and 4.4%. So this is a 6 beat. This is literally 6 all the way across on all metrics is a beat. And interest rate expectations here, we're seeing, let's take a look. It was 50-50, so to speak, and right now we are somewhat pegged at, yeah, it's pretty flat right now. It's like the market's kind of still pretty indecisive. Now, going over to the report and some specifics here, we did see trade come down 0.8%, once again following up with that January number, 1.1% decline in transportation and warehousing. If you take a look at energy, energy was once again the big leader, and food prices also coming down on the wholesale basis, not so much on consumer basis. Consumer basis, I think food prices were still higher in yesterday's CPI report, but food prices, I think this will translate into the CPI report eventually, because we have seen a couple consistent months here of month over month declines for wholesale prices, right? 2.2% decline in food prices, but it's not really translating over to the CPI. Eventually it might, and energy prices down 0.2%, and as a whole 0.2%, 0.1% as a whole, and 4.4% on a year-over-year basis. Yeah, overall, I think it was a good report. Market's still expecting at least 25 basis point hike going into next week. This is a good disciplined market, in my opinion. But retail sales, what does that tell us, right? The economy is weakening. This is a pretty substantial decline month over month. And again, that's going to increase some fears, some expectations of a potential recession either by the end of this year or early next year. We've already gone over a lot of different indicators such as money supply. We've talked about, excess savings kind of depleting, savings rates come down pretty substantial as well. And I think by the middle of this year, there's going to be a time where there's not going to be a lot of excess savings anymore. And we're going to have to really tap into a lot of debt. And we already know consumer debt is sitting at record levels, $1 trillion in credit card debt, 11 trillion in mortgage debt. So I think combined, they're sitting a little bit over 19 or $20 trillion at the moment. It might be a little bit lower. But anyway, so let's see some of the questions here. So Bass is asking, why no moon? I'm so confused. And a couple of questions here. Why are we not pushing higher? I actually did a video exactly about this, right? I did a video. I don't know how many of you guys watched it, but if you go over the interest rate expectations here, let me see if I can bring that up. Dovish pivot. That was a spreadsheet. I don't know if it's going to open up here. Let me see if I can bring that up. Yep, so this right here was a spreadsheet, right, that we talked about in that video. And again, go ahead and watch that video if you can. I posted this, I think, a couple of days ago. But in that video, I pretty much explained this idea that in 6 days, we had a massive shift in the Fed funds futures, right? If you think about it logically, we had a huge dovish pivot on interest rate projections. On March 14th, as of yesterday, right? Today is the 15th. Yep, so as of yesterday, this right here was the expectation for the Fed funds futures moving forward. And this right here was, 6 days ago, March 8th, 2023. And this is a big shift because by June and by July, the market before March 8th, and this was right around, Jerome Powell's testimony. I think March 8th was the second day of his testimony at the U.S. Financial Services Committee, was expecting 6% from an interest rate hike standpoint as a terminal rate. And that came down to 4.75% as of yesterday. I have to double check where we are today, but this is a huge shift, massive shift on a dovish side, right? So 1.25%. And this is three times in a row, 3 meetings in a row. So July, September, and November, we came down for a full 125 basis points. And yet the markets could not find a way to rally, could not find any momentum to push higher. And the reason I pointed in that video, what was that reason? Can anybody Can anybody, if anybody watched that video, I want to hear from you. What was that reason as to why the markets were not able to find that momentum despite such a strong dovish pivot in interest rate projections? Because you think about it, right? I mean, we saw 125 basis points shift back. You'd expect the markets to be bullish about that, right? Lower interest rates, right? You'd expect the markets to be higher. But we didn't see that. And even today, like after the inflation prints that we got from yesterday and today, we're not really seeing a lot of momentum for the markets here. Kevin says TMF is pumping. Yes, TMF is pumping, definitely. It's pushing higher as yields are once again rotating back lower, 5.5% decline here. We are now under 3.5% for the 10-year yields. So that's definitely dropping aggressively quite a bit. So what was that? If anybody checked out that video, what was that? The reasoning. So yes, Mid says earnings. Earnings was a big concern for us, right? I actually addressed that in that video, talked about the S&P 500 earnings as a whole. And even if you take a look at the forward guidance for 222, 219, considering how you spin it, we're still at a level which can be argued as slightly rich. And I think the markets were underscoring the idea of a potential recession and earnings declining. Because all we have seen since June of last year is earnings come down, right? They've just come down. They came down from 250s down to 220s. Who's to say that they're not going to go from 220s down to like low 200s, right? And if they do that, then all of a sudden you've got a richer market that you're in, right? Right now at 3,800, 3,900 for the S&P, you can kind of argue that we are trading at, kind of expensive multiple. So I think that's what I kind of mentioned in that video, and that's something that I wanted to get across in that video is that even though we're getting a huge dovish pivot on interest rates, I mean, we're literally expecting the Federal Reserve to pause next week or start cutting before the year end, and yet the markets are not able to find that momentum. Of course, there was that systemic risk related to Silicon Valley banks, but that was stabilized a little bit from the government's intervention. But eventually, I think the market's going to realize that earnings are not going to be, in my opinion at least, not as strong as what we previously anticipated. And if that's the case, then we could start to see a bit of a pullback. And again, unemployment is starting to tick back up, right? So what did the two reports that we got in the last couple weeks here is unemployment ticking higher from 3.4 to 3.6 and retail sales declining. Those are your two very clear early signs. Even though they're lagging indicators, those are your very clear early signs of a potential recession type environment forming, right? Not saying that we're in one, but those are the first cracks that you see. Consumer spending pulling back, right? Companies laying people off, unemployment starting to kick back up. And what's worse, higher level of interest rates or a potential recession, right? Markets can rally on this dovish pivot in the short term, sure. But what is facing us in the future? What is something that we have to kind of get across, right? And that's a potential recession. Not until we are over that, the market's not going to be able to find any type of momentum, at least not in my view, considering the market value still remains a little bit on the higher end from an earnings standpoint. Yes, the difficulty to lower inflation after 5%, that's also a potential expectation here, but we got some good prints, no doubt. We got some good prints. And again, quite an interesting move here in the markets with stocks 600 dropping, I think even further. So if you take a look at the European stocks, which were absolutely getting destroyed, they are down a little bit over 2.7% right now, so selling off even further. And we got QQQs down about 1.4%. We got SPY down 1.9%, so SPY really selling off here. And let's take a look at our XLF, the banking sector. It's down a little bit over 3.47%, so definitely selling off, watching 29.50 for XLF. And FAS also obviously selling off quite a bit here. I think 4 or 5 or probably even 9% here pre-market, considering that this fear around banks is once again back in with Credit Suisse. So I'm going to close out this spreadsheet. We already discussed that. Let's see. So Patrick, wasn't when the Fed pivot that we would find that the last leg lowered the markets? Not necessarily, because a recession is a much bigger problem than interest rates. I mean, they can pivot, they can pause, and that doesn't necessarily mean the markets are going to find a way to kind of rally right back higher because they've paused or they've started cutting. The bigger problem is the macroeconomics. It's like kind of facing reality, so to speak, right? Eventual reality. It's like recession and kind of inflation are kind of staring us in the face, and it's like we can't just bypass those things and keep pushing higher. Like eventually we have to face it, right? Kind of face the state of the economy, and which is if earnings start coming down, if there is an environment of potential recession or stagflation, market's not going to be able to override it and just keep pushing higher despite what's going on in the background. Eventually we'll have to face that reality, and previously, as I've mentioned, like markets might have underscored the possibility of those things happening. We were too fixated on the interest rates, right? Very much fixated on the interest rates. That's why I mentioned the markets are playing a very dangerous game of just like focusing too much and being fixated on interest rates and not really focusing on what the reality of the situation is with respect to the economic conditions. So, all right, so PPI poll is going to be done. It was pretty split across the board. We're going to start a new poll here with the markets. So markets today, green, red, or flat. And make sure that you do answer. And we'll see if any buyers bite. We'll see if there's any momentum intraday for any buyers to step in. I mean, this is a pretty substantial gap down. So, I wouldn't expect for us to have like a brutal 3 to 4% day. I mean, if that happens, that'd be crazy. But it's not unlikely for us to assume that, okay, there might be some buyers that decide to step in intraday and we see some momentum for the markets back higher. Green. So Volboy says, Scotty, just wanted to share some thoughts about your Adobe video with software like Premiere and DaVinci. It's like today Premiere may run 2 to 3 times slower, but Adobe has money to dev that can address this issue. I don't know the kind of software, but this can be because of the advantage of some hardware capabilities. Adobe can definitely fix this. Yes, so I think you bring up a great point. I totally agree. And, Adobe's got the resources and, DaVinci, I actually downloaded DaVinci today. I'm going to be using it starting tomorrow. And if it works out for me, then I'm just going to be, switching over completely from Adobe. And, I actually did a video talking about this. And the reason was because it's really important for us to address some of these vulnerabilities, right? Some of these potential threats, because it's quite interesting, right? I mean, no company is immune. Like we've talked about this, how any company that you believe to be immune or to have like the perfect business, right? It's just like untouchable, is also not immune to disruption or to technology, right? The momentum can shift so quickly. And I think Adobe will find out what happens with earnings and, what the numbers look like and how they end up doing. But Blackmagic Design is definitely coming after it. They're taking significant share away. And some of the biggest content creators that I pointed out in that video, some of the, YouTubers that I follow on a more filmmaker standpoint are suggesting, their followers and, kind of using their influence, and they're using DaVinci Resolve as well, which is a big problem, right? Adobe needs to retain their customer base, which is using Premiere Pro. And I think the biggest issue has been pricing. I'm not going to lie. I mean, I've hated, Adobe's pricing power. I mean, even though it's like a necessity, I've kind of had to pay like $57, $50 per month to them. But if I had the option, like I prefer buying a software for life and just not having to worry about anything else, than as opposed to anything else. So Blackmagic Design, unfortunately, is not a public company, right? So the company that actually owns DaVinci Resolve. So they don't have the pressure of having that recurring subscription. So that's another thing that I wanted to point out that I forgot to mention, is that the Blackmagic Design can only go as far as a certain level, right? You can't offer lifetime access to the entire market and have no recurring subscription or no recurring revenue. Because in that case, if you saturate the entire market, let's say that you grab all the market share from Adobe, what do you do then? Right? I mean, you have no revenue coming in, like a very minuscule revenue stream, and you've got all these creators all over the world that you need to kind of service with your platform, and you need to constantly give those updates. That's not easy to do. So, that is like a little bit challenging to really understand. Like, what is that business model going to look like 5 years from now or 10 years from now once they've saturated the entire market? Because if no recurring revenue coming in and you've got everybody using DaVinci Resolve, what do you do then? So it becomes a little bit more difficult to kind of take into account that. Adobe definitely still has, I think, a very sticky business model. Love the company, love their software, love the products. But yeah, just be cognizant of the fact that yeah, DaVinci Resolve is coming after Adobe's market. So yeah, many options out there. I'm super basic and not even close to the level of most, but it lets me do everything I need. So that's good to know, Anthony. And also, we do have to take into account that DaVinci could reach out to these YouTubers and pay them for their opinion, saying DaVinci is better. Bad software, but Premiere is very mature. No, that's true, but I doubt Peter McKinnon and content creators like Sam Cold are gonna be just doing that because they want to make a few bucks. I kind of hold them up to very high integrity. So I trust Peter McKinnon when he gives out his opinion on filmmaking and video editing and all that stuff. I don't think he's gonna do that with DaVinci Resolve. If he really likes that software, I think it's coming from a good thing. It's coming from actual research and him having to use it. Other than just doing it for a sponsorship. I don't think that's going to happen. Anyway, so TMF on wildfire. Yeah, so yields are rolling over and they are dropping pretty heavily once again. They're down almost 6% at the moment, so pretty aggressive pullback on yields. So what we have really seen is once these bank fears will come on board, like for today with Credit Suisse and European banks, investors have kind of seen this as a flight to quality trade. Yesterday was once again risk on. Today is once again risk off and flight to quality. So investors are kind of flocking towards safety once again. So later you may want to check the comments from Mohammed El Arain. Fairfield leads to Swagbox earlier today. So let me just see if I can bring that up right now. Was he on right now, like earlier today? Oh no, Kramer's on now. Cryptocurrency, fair value on the markets, global stocks, European stocks. We can listen in. I mean, these are the numbers. Yeah, I think Kramer's on now, so we can just go back to talking. About 45 minutes ago, I don't see him on there. If he was, I would definitely play that. But bring back the red mic. But no, eventually maybe I will. Volatility here once again with a huge spike, 17%. Rally back higher, 27 is where we are. And again, last 3 days it's been risk off, risk on, risk off. It's very much back and forth, right? The market's very indecisive in current environments. The one good thing that we have seen with this is crude oil prices. They are now dipping below $70 for the first time since December 21. December of 21. It's been a little over a year, 14 months since we see crude oil prices dropping below $70. This is absolutely going to help inflation get better. So that's good, 2.5% decline here. And next support really is going to be down to $65 per barrel for crude oil. Bitcoin actually surprisingly still green, pushing higher. Ethereum slightly lower, back under $1,700. But the big move down is on the yields. And what's really interesting is that this spread is almost positive. We were extremely negative, down to negative 108, 109 basis points between the 10 and the 2-year. It's now negative 43 basis points. We're seeing a little bit of momentum back up for this spread, and only negative 43 basis points. We're seeing a lot of momentum for this. If it turns positive, that's great. That recession indicator kind of goes away, but that still keeps us, on edge for a potential recession down the road, right? Just because it turns back positive doesn't mean it's gone. It just means that, it's the bond market's kind of stabilizing a little bit with the 10-year yield once again yielding more than the short-term rates. So the bond market's stabilizing a little bit. So any thoughts on the Russian jet incident? Things seem to kind of be heated right now, geopolitical speaking. So I didn't read up too much on it, Kevin. I'm not super aware of what happened with that jet incident. So I won't be able to speak to that. But as soon as I get off the live stream, I can do some more research and share my thoughts. But I'm also not the best person for geopolitical stuff because, again, that's not an area that I like to dabble too much in when it comes to geopolitics. It feels really manipulating, right? Geopolitics. It's a very, very sensitive type relationships. It's crazy how countries work with each other. They can kind of be friends in front of each other, and of course, be completely different. So Elon Musk buying Credit Suisse and SMI. Let me see if I can bring this up. All right, so perfect. All right, so we got 56% expecting the markets to be red today. 33% still expecting green. So we got some strong bulls in the live chat here, expecting the markets to rotate back higher. Nasdaq still down 1.4%. We got the SPY down a little bit over 1.89, and Euro stocks down over 2.7. Euro stocks really hurting at the moment. It's a very touchy situation. Yeah, I can imagine. Someone says, okay, Caddy, I don't know know these YouTubers, but trust your opinion. Yeah, I mean, Peter McKinnon's like a filmmaker. He's got like 5 million subscribers. And Sam Cold is also a video filmmaker. And they actually do a lot of, filmmaking for brands and companies, and they do like a lot of video creation, right? Their videos are pretty awesome, pretty sick. Yeah, there are no allies, that's for sure. I mean, everybody is obviously looking out for themselves. It's in everyone's self-interest. So, Chris, a cool sheet on unicorns, Caddy. Thanks for posting it. Yes, so that is super important. I just posted a video about an hour ago. If there is one video you're going to watch on this channel, I highly recommend you watch that one. I would not push any other video to you guys, but that one I'm giving out a free spreadsheet that you can download. Literally, just go to watch that video and you can get access to over a spreadsheet with over 1,200 companies that I think are worth researching, analyzing, and definitely, something that we need to look at, right? Keep it on our watch list. And this is going to be a collaborative effort, right? I can't go over 1,200 companies by myself. So that's why, we're going to do it collectively, right? That's why the spreadsheet is open source. You can kind of check that out. It's open for the public. You don't have to be a member to download it. So check it out. If you have any companies that, pique your interest, do research, then we can definitely look into it more for when the time comes for when they go public, right? So very, very important video. So let's see. The bear is hidden in the corner. Yes, the bear is hidden in the corner, and it's I kind of pulled it back a little bit from the thumbnail. But if the day, obviously today ends up red, pretty red, it's gonna come back into the picture a little bit, and it's gonna be a constant battle. I'll just kind of try to move them around. And it's been a tug of war, really. It's been a lot of back and forth. Even yesterday, we kind of gave up on most of the gains. And then we started to kind of rally back higher towards the end. Yeah, so Chris says, save that list and watch for those companies, research them, and you'll find some big baggers over the coming years. Absolutely. That was the whole point. You summed it really well, Chris. That was the whole point of that video. And that list is to literally just find the best gems from that list and the companies that are going to end up being 10 baggers, 100 baggers over the next 10 years, 20 years. And there's some pretty good companies out there, right, from that list. I'm super excited for TradingView. I'm super excited for Discord. There's a lot of them on there. So yes, Mercado Libre, Haas, I've actually looked in that company before. I like them as an online e-commerce platform, but I believe the valuation was a little too high for the business. So I wasn't... I don't know if you're into cars, but if these videos editing YouTubers are like Doug DeMoro, then we can trust them. Okay, I haven't checked out him. Maybe I will. But so Mercado Libre here, obviously the all-time high, well over $1,800, and it's been sold off along with all the other e-commerce stocks. But 61 billion here market cap, very, very good revenue growth, and now starting to turn profitable with higher revenues and earnings as well. Let's take a quick look at the valuation. So 122 times earnings, right? So we are definitely trading at an expensive valuation at the moment with over 5 times sales and 25 times cash flow. So that's a little bit on the high end for me personally for Mercado Libre. So I would, have a little bit of a pass. The 10-year yield is dropping now down to 3.459%. That's an alert that just went off. So let's just take a quick look on where the yields are. So yeah, we're seeing a pretty aggressive sell-off here in the yields. Not really a sell-off. We're seeing a lot of demand for bonds, which is resulting in the yields to pull back. So Steve says, Kevin O'Leary said, stay away from bank stocks and buy energy. That's quite interesting. Bank stocks, I think it really depends. What type of bank stocks are we talking about here? I mean, sure, there can be a contagion, but I still do like SIBs in this environment, like systemically important banks like XLF. I'm waiting for $25. Like I'm waiting for actually $29. That's the level that I'm watching for XLF. Like I would be interested at that price. 29.50 to be precise. I'd be interested. It would be oversold. We'd have an ETF. I would have an ETF with, JP Morgan, Bank of America, Wells Fargo, some of these big banks as being the ones in that ETF as the top holdings. So yeah, and the price to book would be lower. Price to sales, price to earnings would be a lot lower. So I don't actually mind XLF. At around 29, roughly under $30. So buying today met at 190, wait for a pullback 186. So I kind of mentioned that it's no longer Mark Zuckerberg, right? It's more like Market Zuckerberg, because the shift in the tone from Mark Zuckerberg has been quite significant over the last 6 months. He's really learned how to play the Wall Street game, and it's all about job cuts and cost cuts and efficiency, and lower spend on the metaverse and focusing on the core business. So he's really kind of evolved in this, more focused on what the market wants to hear. And as a result, I mean, it's the best performing stock since November, right? 123% gain. The market's kind of rewarding that. So 198 close to 200 is that resistance for Meta. And support level is going to be taking a look at 168. That's a level that, it's going to be at the upper half of that gap. And we got a support right there for Meta Platforms. Yields definitely are struggling quite a bit here. So, all right. Does anybody want to listen to what we have going on with Kramer? Let me know. They're talking about Credit Suisse Bank. But let me know if anybody wants to listen in for a few minutes. Actually, you know what? I'll play it just because I need a sip of water.
The CDS, stock price, the questions that continue about outflows from the company in terms of people saying, I don't need my wealth management account there. That's a question mark here. I will tell you guys, though, and obviously, as you might imagine, I've been speaking to a number of people involved with this, close to the bank as well. 14.1% capital ratio is strong. Liquidity ratio of 144% to as high as 150% is quite strong. This is not the banking crisis we saw here with Silicon Valley Bank or Signature, where you're talking about a bond portfolio that's deeply underwater or something else. This goes back to the overall concern, which is people just keep saying, why do I need to bank with you? Why do I need to keep my money there? I can go across the street to Julius Baer, I can go to UBS. Right. They do have, by the way, a significant plan with the Swiss National Bank in terms of contingency plans that would provide them even more liquidity should they even need it. But the question, Jim, becomes, does the marketplace need Credit Suisse? And that's sort of where they are in a position where, you got to tell everybody. We have a strong capital ratio. We have strong.
All right. I feel like Kramer's about to come on board, so let's just turn back over. So anyway, if you have any stocks you want me to go over for the next 20 minutes or 15 minutes or so, I'm happy to do that. Cat, you drinking wine straight from the bottle there? No, that's actually my water bottle. I keep water in a green bottle. So, yeah, it looks cool against a green screen. It kind of looks invisible, right? Because you can't see it because the background's also green. So it's kind of like holding nothing. It's kind of, yeah, you can kind of see through it. But anyway, so if you have any companies, stocks you want me to go over, happy to do that for all of you before we get started with the market open here. But yields definitely rolling over. We're now down to 3.4.5%, and that's across the board for all yields. And equities also stabilizing a little bit. Again, I wouldn't be surprised if you do see some buyers to step in intraday. It's possible. but we're going to keep a close eye on the stocks 600, QQQ over here, and we got SPY over here as well. And volatility is still up over 17%. So let's take a look at UiPath. We haven't analyzed that stock in a long time. And then Tesla, again, we Tesla analyzed it yesterday. But let's take a look at UiPath. How is Discord making money? They do a lot of subscription too. Like I do have Discord like Nitro that gives access to the community with a lot more features. That's one way that they make money. But I'm sure there's going to be other ways as well. And yes, ChatGPT 4 is launched. I think that is going to be quite interesting. Webull is going to pay 4.1% interest while you have cash sitting in Webull. No way. 4.1%? Is that really? I don't believe it until I see it. Can you share the link, Matthew? That would be great. That would really help us out. But 4.1%. I mean, I know they are SIPC insured, so I know deposits will be insured up to a certain point, but 4.1% on uninvested cash. Let me share the link. I'm quite interested in that. But Path here down 2.5%. I mean, this has been nothing but a significant downtrend for the company, down about 85-90%. Still waiting on profitability though. Not quite profitable yet. So all we can rely really on is sales. And there we go, another 10-year yield alert. And sales last year 900 million, trading at 8 billion. So that's a little over 10 times sales for the company at the moment. Wow, 4% interest with cash in it. 3.8% with interactive brokers. Same with Robinhood. That's incredible. That's pretty crazy. Wow, that's I might have to skip over my T-bond ladder here and just go after Webull, I guess. Just cash deposits if they're paying that much interest. So one thing that I can think about when it comes to banks, and the only risk that I see for systemically important banks and some of the regional banks, is the fact that their net interest margin might come down as reserve requirements go up, and maybe they interest on these deposits might go up as well. It's possible that their net interest margin starts to come down, right? The cost at which they borrow versus cost at which they lend, that difference, that spread, is what the banking sector is pretty much made up of, right? That's their bread and butter. That might start to come down as reserve requirements go up, so they're not able to lend as much, and then the cost of borrowing goes up as well. So that's one reason why banks could be a lot of under pressure, but $29 close to $30 is still going to be that support for XLF that I'm watching. All right. Big banks are cheap. So let's see. CrowdStrike, we've already done a video. C Limited, I believe I've actually done a video on them as well. But let's take a look at CGNX. Cognos Corporation, we've got 8.8 billion. Pretty good revenues, profitable. That's good, but doesn't seem to be a lot of growth for the company. 38 times earnings and 8 times sales. And EPS expected to grow pretty well from $1 to $2.29. That's pretty good growth. Negative net debt, that's also pretty good. And share count has remained pretty stable. So it seems like a good company, which I'm definitely going to add it to companies that I need to do videos on, maybe do like an analysis in the future. But yeah, looks pretty good from what I can see. I mean, we've got a stable share count, we've got negative net debt, so more cash than debt on the balance sheet. Valuation is a little concerning. 38 times earnings is a little too high, but they've also got a growth rate that is pretty good. From $1 to $2.29, that's over 100% growth in the next 4 years for the company. So couple support levels that I would mark out is 41.45 down to 33.57 for CGNX. What's the support for Tesla? So Milan, for FAS, we'll be looking at lower levels, obviously, at closer to, well, XLF, we'll be paying attention to that. See if it comes down to 29.50 because it's very much correlated with the banking sector, right? So XLF and FAS will kind of move together. But yes, I will be looking at cash secured puts on FAS most likely. It is going to be a risky play, but I will be looking at cash secured puts and see what the premiums are like after today's open, considering that we're down 9.7%. So that's definitely going to be on the radar. Tesla here. Down 2.3%. So after, the numbers coming out, inflation, retail, everything, support's going to stay about at 175 to as low as 166. So those right there are going to be a couple support levels to watch for Tesla. So pretty strong support here for the company there. Yes, I did a video on CrowdStrike. I'm not sure if I did that after or before the earnings, but I definitely did it around the earnings. Yeah, so high yield savings account, Marcus from Goldman Sachs. Yep, I'm aware of that as well. 3.75%. Ally Bank also pretty high returns on online savings account. I think Wealthfront might be a little bit good too for savings rate. But the reason why I wanted to introduce T-bill ladders in the first place is because yields were higher and they were backed by the full faith and credit of the U.S. government as opposed to a bank or a broker, right? So that was the whole motivation behind going after building out bond ladders is because you're investing with the U.S. government, treasuries pretty much, not really putting it into a bank account, which may or may not fail in the future, right? As more and more of these bank failures happen, that was the motivation behind going after bonds as opposed to CDs or bank deposits. Toronto Day, yields in the banks are also much better now. Yep. But again, from a risk standpoint, that was the whole motivation going after bond ladders. So we'll definitely do some thinking about it. Credit Suisse for Kevin. So we are definitely gapping down pretty aggressively. So 29%. And it's just been under so much pressure. I mean, I remember this has been going on since October. Absolutely wild how much they've sold off in, obviously since 2007, 2008. They've never really recovered after the great financial crisis. They're down 96% from those levels. Absolutely wild. They're going to be worth under $8 billion after today. I mean, it's like if these companies keep falling like they do, Elon Musk could literally just scoop them up for a couple $1 billion here and there. That's like what? Just a few million Tesla shares, and he could buy like Credit Suisse, Silicon Valley Bank. Twitter he's already bought. SpaceX he also owns, the Boring Company. We've got Tesla. And he could literally just keep on buying as these company valuations keep on falling. And just really just be this global owner of most companies. AMD here. Let's take a quick look. AMD here had a very strong day yesterday. So we are in a very, small uptrend. So higher highs and higher lows. So that's going to be that level. Resistance, we got to support the higher low over here for advanced micro devices. So more or less just get it at 10 cents and then start a country. So, okay, 56%, still a little pessimistic on the day, expecting red, and 33% expecting the markets to push higher. That's the poll result right now. Let's see if the interest rates have changed a little bit. Or at all. All right, so now no cuts. No cuts priced in from the market. 52% probability that we're not going to see any hike. Wait a minute. This current number is, yep, so no hikes. This is exactly where we're going to be. And then one hike in May for 25 basis points, and then two cuts, another cut, pause, cut, all the way through 2024. Market's pretty optimistic about cuts here. What's going on? Market's like certain that, okay, starting June, July, the Fed is going to cut. That doesn't happen, man. Help us. Save us. If that doesn't happen. It's possible if inflation by then comes down at under 4%. PCE starts to roll over. It's going to take a few more events from a macroeconomic standpoint. From a recession standpoint, it's going to take a few more reports. Unemployment needs to go up. Recession indicators need to kind of start showing up. And retail sales really needs to decline in order for the Federal Reserve to really start cutting here. So just wanted to know your take. Do we revisit October lows? What do you think, considering anything that happens like CPI, PPI, Fed's tone, banking system problem, etc.? I think it's possible. I think the market continues to underscore the probability of a recession and earnings coming down, and the fact that the Federal Reserve may not be as aggressive in cutting rates as they anticipate. Wouldn't be surprised if we come down to October lows. It's also possible that we just, trade sideways. Like, we don't really go anywhere, but instead just go sideways, And starting tomorrow, I feel like I need to put kangaroos on my thumbnail and get rid of the bulls and the bears. It's more of a kangaroo market because we're just back and forth. Yesterday was risk on. The day before was risk off. Today, once again, is risk off. And it's just like us going back and forth. The Fed just keeps making mistakes. It's like the Federal Reserve is trying to... Oh, Bhavneet coming in, firing the shots here. Kevin, why don't you apply for the Fed job? I love it. Yeah, the PPI was a good report, but the market doesn't seem to be liking it. I think it's also baked into the interest rates. The market does expect no hikes, but it's still not rallying. So it's not so much about the market not liking it. I think it's more about what the reality of the situation really is. Harshal, how does one trade TQQQ? Well, it's an ETF, so you can simply just trade it as anything else. You can buy it as an ETF. So I don't know if that was your question, but if you're asking specifically when to trade it or how to trade it, but yeah, it's just an ETF. You can buy and sell using your brokerage account. It is levered, so on a daily basis, it does rebalance on a daily basis. So it's going to be pegged against the QQQs, which is the NASDAQ ETF. So every time, I tell people that if you're trading levered ETFs, there's no point going over the support resistance levels for them. It's more important to go over the underlying index or the stock or the ETF that it follows, because that's really what's going to be the technical analysis based on, right? This is what actually trades on demand supply, on support resistance levels. The levered ETFs are simply based off of their underlying, tracker, whatever they're tracking on an underlying basis. That's what they're based off of. So. Kevin says, I'll take it. Everything will be fixed in 90 days. Kevin, what would you do? What would you do in the next 90 days to fix inflation, recession probabilities, the market, consumer spending, gas prices, everything, and the housing market? There's a lot to go over. How are you going to give us a step-by-step plan on how are you going to fix it? So our charts you still read? Yeah, for QQQs, absolutely. You have to look at the underlying ETF. That's the QQQs, right? Caddy can do it in 15. Oh, no. I mean, macroeconomics is a whole other animal. It's not, it may seem easy from the outside looking in. It's not really. There's a lot of moving pieces. It's a lot of moving pieces. And sure, the Federal Reserve have made mistakes, several mistakes, right? Calling inflation transitory and then kind of being too late to raise interest rates, and now probably at a point where they're overdoing it. They're definitely making a lot of mistakes along the way, but there's a lot of moving pieces to just handling monetary policy, having that dual mandate. So it's not going to be that easy, my friend. So Walt, Caddy, just wanted to say kudos to you for all your work. Just 2 years ago, I had little knowledge about the economy, market, bonds, valuing companies, and now I understand what is going on in the world. Thank you. I appreciate that, and that's been the goal from since day one. So I really appreciate that, and glad to hear that you're able to, do all that and become self-sufficient. So appreciate that. Thank you. Yeah, oil is falling quite a bit. So I will crush the consumer. Oh my God. The audacity to come here. Crush the consumer. Wow. Yeah, QT could be moderated as liquidity has become an issue as per the banks here. And of course, M2 falling as well. That's another, recession indicator or something that as contracts, there's, bigger risks of deflation as well. And that's kind of crazy, right? I mean, at one point, you're kind of battling through inflation. Inflation needs to come down. It needs to come down. It needs to come down. And then all of a sudden, if money supply continues to contract, we see a lot of QT. We kind of swing all the way to the other side and start going negative and start seeing deflation if that happens. But there's one thing, right? If we actually see a deflationary recession, what I can tell you what I will be doing. I'll be buying assets, buying quality assets, buying quality companies left and right, like literally just plowing money into the markets and loading the truck. If we see a deflationary recession, if unemployment starts going up and inflation actually turns negative, that would be just a setup for a crazy market rally in the future. It's insane. Denny says, I'd raise rate hikes to 10% short-term pain for long-term reward. Yeah, that would just crush the economy in the short term. I mean, you're seeing one or two banks fail at 10% interest rates. You'll pretty much see the entire system collapse, and then that's it. You're just as you started working, and within 24 hours, you're out of the Fed job. So that's why I said it's not that easy, right? It's not as easy as it looks from outside looking in. But yes, I mean, I'm sure there's a lot of different opinions about how monetary policy can be handled better, what can be done. I do think there has to be an overlap between monetary and fiscal policy. You just cannot expect monetary policy to work in isolation when in the government, in fiscal policy, people are just like constantly printing money. And then, there's a lot of spending happening. There's fiscal deficit with the debt ceiling. Everything that's going on in the fiscal side needs to have some overlap with monetary policy. And the fact that Jerome Powell and any monetary policy Fed is so reluctant to comment on fiscal policy is crazy. It's beyond my understanding as to why they would not work together instead of just working in isolation. Doesn't make any sense. TLTs are rallying. Yep, so they're rallying quite a bit. Easy helped me as well, so that's great to know. Appreciate that. But let's see. We got 5 minutes till market open. Do expect some potential upside intraday. Would not be surprised if you see that. The 10-year yields continue to come down 7% now. And TLT is up a little bit over almost 3%, and TMF is up over 8.6. Once again, back up to over $9 per share. Sanjeev, any plans? Not anytime soon, but hopefully in the future, but not anytime soon. All right, so a little bit of momentum coming back in. Still down 1% though. So, and then we've got Tesla here down 2% still, 179 close to 180. We've got Google here down about close to 1%, Apple here down 1%, and Microsoft here 0.73%. Mr. Juventus says, I haven't looked at my portfolio for 2 years. How are people handling these periods of times? Wow. That is a really long time to have not looked at your portfolio. And 2 years, I mean, there's a lot that's happened. I don't know. I find it hard to believe that you haven't looked at it for 2 years. What? That's crazy. Not even for like, I mean, you must have looked at it when got the documents, you kind of filed taxes and stuff. Like you definitely must have. But that's crazy. So Dilip, why are equity markets down if PPI came out good? We had a whole discussion about it about an hour ago. But long story short, I in my opinion at least, the market's still kind of having that underscoring the probability of a potential recession. Valuation still pretty elevated. We are still expecting no hikes going into next week from March 22nd, but from an earnings standpoint and a valuation standpoint, it is still a pretty uncertain time for the market. And of course, if you consider the systemic risk going on with banks, and this morning with European stocks and European banks and Credit Suisse down 29%, you're once again seeing a bit of a flight to quality away from equities over to bonds, which is why the yields are coming down. Bond prices are pushing once again back higher. Yeah, 2 years not looking, that's discipline. That really is discipline. So Bhavneet, please plan a meetup in Miami or in Fate Lauderdale. Is that what that is? Just short for that. But no, I will plan something definitely soon. Most likely will be in the US this summer, in June or July. So we'll keep you guys posted. Last time we did it in New York back in October. So I was thinking more on the West Coast this time. But again, I'll keep you guys posted. I was thinking more like Los Angeles side. If anybody's there, just let me know. We'll see if we can set something up. Never been to Miami. I eventually might go down there, but not in the plans anytime soon right now. Anyway, so a minute 30 left for markets to open. Volatility is still spiking here. 17% move to the upside. We've got crude oil prices absolutely getting dropped under $69 per barrel, which is good because of inflation, right? Because of inflation, the lower this gets, the lower the reads will be in the future. And this is good for consumer sentiment. This is good for overall prices for wholesale as well. So this is the first drop we're seeing in a year and a half. Last time we saw these prices was back in December. I think even going back as far as November of 21. And of course, markets are gapping down. However, I wouldn't be surprised if we do see a little bit of momentum intra-day. Stick to the east. San Francisco so Los Angeles sounds good. Please not in Boston. No, I will be in Boston, but we're not planning a meetup there. San Diego. Again, California, there's going to be so many places, right? Where to do it, but we'll come up with a plan. Don't worry, we'll come up with a plan. So we'll definitely do definitely the West Coast. We just got to figure out what place, because I know California is going to be like all spread across, San Diego, San Francisco, like. So we'll kind of come with a plan. Definitely on the West Coast. If anybody wants to obviously come by, you're more than welcome. But anyway, markets are open now. So let's see if we see any buyers stepping in. The Dow opening down almost 500 points. We've got the S&P 500 here down a little bit over 1.3. And we got the NASDAQ here down about 1% as well. Yields still down 6%. And of course, a lot of individual stocks also rolling over at the moment. So Tesla 180, 150. Google here down. So most of big tech is down. Meta is from yesterday. It needs to update. Because I was going to say, like, there's no way Meta's up 7% right now. So pretty flat. Down 30 basis points. AMD is still pushing higher. And then we've also got, Zim Integrated Shipping up 10%, back up to $23. We got Coin Shopify. These are not updated, are they? Yeah, it's taking some time to update. There we go. Shopify down 1.8%. DocuSign is down 2.4%. And UVXY is the only one that's pushing higher on, of course, volatility, which is up 17%. We'll see if TMF actually finds a way to actually have a green candle. I mean, last couple of days we've seen momentum, but all we've really seen is intraday selling. So Hawaii is the best. So yes, M&A, I'm actually gonna do that as well. Thanks for recommending that. Bullet bond ETFs. It's ETFs that you have maturity dates and can be a good tool to build ladders on corporate bonds with diversification. Only bad part is low volumes. Yes, I'll definitely do some more research on that. Thanks for mentioning. And bond ladders is going to be a good part of our strategy when it comes to capital preservation moving forward. We're going to be starting with that in the upcoming months. So yes, we'll definitely be looking into that as time goes on. All right, so Nasdaq still down 1, S&P still down 1.3, the Dow is down 1.5. Let's run through our more important watch list, which is the banks. Let's see how the banks are doing. All right, starting with the worst, we've got Credit Suisse down 25%, First Republic down another 22%. DPSD, which is your regional bank levered ETF, down over 14. We got WAL, Western Alliance, down 11. BNP Paribas down 11, Deutsche Bank down 9, UBS down 9, CMA, Comerica down 8, UCG, so UNI Credit, Italian bank, down 7.5%. We got Barclays down 7.6, HSBC down 5.9, PNC down 5.7. So it is pretty brutal out there in the banking sector, even today. Lauren, I buy the sell-off in TMF. It's good. TMF is pushing higher. Well, I'm kind of interested to see if you actually can get a green candle here. Last couple of days have been just red candles, so a lot of momentum down, and it's not able to kind of keep that momentum higher. Yields have been able to push higher both of these intradays. So Tesla down almost 2%. We got Microsoft leading the way up 13 basis points. We got Apple down about 81 basis points. We got Google down about 60 basis points as well right now. XOM at 102. Yeah, selling off pretty aggressively. So pretty substantial amount of sell-off here. And at the beginning of this year, end of last year, we talked about how energy, eventually their earnings are not going to be as comparable anymore, and this trade is going to run off, right? In other words, Wall Street's going to be pretty done with this trade because last year energy was the best performing sector, and as their earnings don't grow anymore, and especially right now when you've got crude oil prices dropping, you've got huge short opportunities in energy. XOM, Chevron, because there's the correlation, right? Crude oil prices drop, energy earnings drop, and their year-over-year numbers don't look as pretty as what they did last year. So I still do think there's a lot of potential downside there. It's already down 13-14%. Occidental has come off from $76 down to 57 now. Chevron's down to 155, down from 186. So NVIDIA never selling off. Yeah, so we'll take a look at Mara as well. Bitcoin's up over 1.4%, so Marathon's up 3.5%, so definitely pushing higher here on the day on back of Bitcoin. But NVIDIA, oh man, the most stubborn stock. I should do a video. The award for the most stubborn stock of 2023 just goes to NVIDIA. Reluctant. It doesn't want to come down. The sentiment's so strong. I feel like it just keeps going sideways. It's more like, it's not like going up. It's not going down. It's not going sideways. It's got a really annoying pattern of just like going down. I don't know. It just keeps on drifting sideways plus higher. That's a really annoying looking pattern here for Nvidia. Just on an intraday basis, you'll find red candles on a green day, green candles on a red day, but somehow it ends up higher than where it closed, than where it opened. So VIX is spiking. Yep, so 14% right now, although coming down a little bit. All right, so what's the consensus for today? Intraday gap up. In other words, are we going to see a gap fill, or do we continue the intraday weakness for more losses? Let me know in the comments what your consensus is. Two options are gap fill or intraday weakness even more. If you make a new low of day, which by the way, S&P has already made a new low of day, it's possible that we see more downside here. May not see a gap fill as anticipated. So QQQ has got a resistance at 298 right now. It's going to be the level, and support down to 290. Lauren, I guess more sell-off, DXY going up. So yep, dollar index definitely can put a lot of pressure on the markets. And, you know, again, a lot of people talk about this US 10-year yield versus the market correlation breaking down. You know, why is it the yields are coming down and the markets are coming down at the same time? I think you have to really look at the liquidity. I think liquidity is the answer here. Why would yields come down at the same time the market's coming down? It's simple. There's flight to quality happening in real time, right? You're seeing a more risk-off trade. You're seeing people take money out of equities and go into bonds. When bond prices go up, yields come down. It's more of a liquidity question than anything else. It's not that this correlation is breaking down. This correlation is still valid, but it's more from a liquidity perspective. So intraday weakness, weakness, more losses. So definitely not looking super great, but the day's just started, so we'll see what happens. Anyway, so again, that's it gonna be for today, everyone. Thank you so much for joining in. We've been live for a little over an hour now, considering that we covered the PPI numbers. So thank you so much for joining. And again, I do want to point out to the other videos, so make sure that you do check that out if you haven't already. I'll go over that right now. So it's going to be this video right here. This is very, very important. Massive opportunities for the next decade, and a free gift, which is like a free spreadsheet that you can download. It's available in the public domain. So it's got over 1,200 companies that we can collectively research and analyze. So definitely check out this video if you haven't already. So thank you so much for joining. I really appreciate all of you. Make sure that you drop a like, subscribe, and the link to our Discord and Patreon is going to be down below. If you want to be a part of our money investing community, we're going to be starting with our will strategy in April and the bond ladders later this year, so in our upcoming months. So once again, thank you so much. Happy investing. I'll see you all